Welcome, everyone, to the next installment of our private equity investment in healthcare webinar series. We've got a topic today on regulatory issues in healthcare payments. I am R.A. Markenson. I'm a healthcare M&A partner here at Venable in our New York office, and I'm joined by my partners, Ellen and Andrew, and I'm going to have them introduce themselves and give us a sense of their practice and what we're talking about today. So, Ellen, why don't you start?
Okay, well, hello, everybody. Thank you, Ari, for the intro. I'm Ellen Berge. I co-chair our payment processing and merchant services group in our financial services group here with my colleague, Andrew Bigart, who will introduce himself in a second. We've got a full service payments and fintech practice. We do a lot of work in this space, helping all sorts of entities that are accepting payments, helping to facilitate the movement of money from one destination to another. We cover lots of issues ranging from contracts to regulatory compliance to consumer protection and everything in between. And we work very closely with some of our other groups, data privacy, security, advertising and marketing, all sorts of other things that relate. So we'll touch on what we can today, but that's just a brief intro here. Andrew, why don't you add on to that?
Yeah, great. Thank you. I'm happy to be here. I'm one of the other co-chairs with Ellen of the financial services practice. And I think Ellen really covered a lot about what our group does. I guess the one thing that she didn't mention that is relevant to this is that we also do a lot of due diligence for potential investments into payment and fintech companies involved in the healthcare industry. And in that kind of work, we obviously collaborate with a lot of our partners, but really come at it from the payments or the financial services perspective. So happy to be here to help talk payments and kind of fintech and healthcare.
Andrew, thank you. Why don't we get started by first having the two of you sort of tell us, why are we even talking about this in respect to healthcare?
So let me start. So we are focusing today on accepting payments in the healthcare space. It's one of many industries that has really just become ripe for new developments and updates on how financial services and financial technology intersect into this space. There's a lot of things at play. We've got the industry, providers, medical providers, healthcare providers looking for ways to get paid faster, more easily, improve the patient experience. We've got financial technology companies, fintechs, who are looking at how they can really capitalize on new concepts of open banking and faster payments and really sort of open up their electronic payment solutions to serve this space. And then we've got lots of intermediaries and third-party companies, software developers who are in the space that are looking for ways to incorporate payments capabilities into what they might already offer to their clients in this space. So it's really sort of a comprehensive effort to streamline payments in the industry, move away from this idea of mailing paper bills and waiting for people to send in checks. I think we're past that now. People are starting to get used to paying their what they need to electronically. And in fact, consumers are looking for ways to pay electronically, and healthcare providers want to accept faster digital payments. But there's a lot of work that we can still do on sort of making sure the whole system is streamlined. Money is getting where it needs to go. Payers have their recourse rights and all the appropriate protections that they need. So there's quite a lot to talk about there. And Andrew, there's also sort of an emergence of newer payment devices available to patients who are paying in this space, or other sort of payers of any type, whether it be digital wallets or debit cards or anything like that.
Yeah, I mean, a lot of times, and we'll spend a lot of time on this presentation talking about kind of the merchant side and how merchants can accept payments. But particularly in the healthcare space, there's a lot of payments companies that are finding ways to help consumers actually make payments directly, whether it's through the issuance of prepaid cards or virtual cards that can be issued to, supplement, a copay or something like that. And so it's really, we'll kind of touch today on both sides, both the merchant acquiring side and the card issuing side as well, and how they can both be used to help facilitate payments in this industry.
Yeah, that's right. So we are going to focus to begin with sort of on the nuts and bolts of sort of basic payments infrastructure and how things move. We will talk a little bit about the regulatory considerations throughout. A lot of this work amounts to carefully crafted contractual arrangements, and there's a lot of ins and outs that need to sort of be known, both with respect to payments and then also the industry itself. There's patient-facing elements, which we would consumer protection type principles that come into play that we'll touch on. And there's a lot, there's money movement and money transmission. There's a lot of things that we'll cover, and there's a lot more we can cover in a follow-up, but we'll do our best today to cover some of that. Andrew, do you think I covered everything?
Yeah, I think so. We can keep moving.
All right. So, all right. Okay, so we're going to start with sort of the payments ecosystem. Hopefully this slide doesn't look too busy, but it's a nice way for us to start to break it down and organize it. It is a little bit complex. It's definitely multi-layered. This slide probably could use updating, frankly, every month. But we've got this version to work off of, and Andrew, maybe you should start with going through this a little bit.
Sure. Yeah, I mean, the chart you have in front of you, the good thing about it is it does kind of segment the payments industry into some of the key players. And so, kind of at the top, you've got what are called, the acquirers. Oftentimes, these are also maybe referred to as like the sponsor banks. And these are typically going to be the members also of the payment networks, right? And so both on the accepting payments, kind of the merchant acquiring side, or the card issuing side, you almost always have to have a bank involved as one of the participating members of Visa, MasterCard, whatever it may be, network. And the role of the sponsor bank is kind of multifaceted. As a member of the networks, they're able to directly sign up merchants to receive payments, or they can issue cards that can be used by consumers to purchase services. But they also have the ability as members of the networks to sponsor third parties to kind of carry out a lot of those functions. And so while the card networks or the ACH network will set the general rules that everybody has to follow and that the banks have to follow, the banks can then contract with third parties to help carry out those functions. And that's typically going to be done through kind of a sponsor bank agreement that helps flow down the different obligations and requirements to the partners so that everybody knows what role they're supposed to play from a compliance perspective, et cetera. And so, Ellen, you want to maybe talk a little bit about the different types of intermediary and third parties that can partner with banks to help provide these types of payment services?
Sure. And this is where we're seeing a lot of growth in this space. I mentioned this earlier with software providers getting into it, but there are different types of models that an intermediary might use to get into this space. Just think about your basic software company. They have customized software for any sort of maybe dental offices or a medical office of some kind. They know the systems, they know the data that's important. They have certain interfaces with insurance or whatever it may be, but they now want to also offer their client customers payments capability. So they are not equipped to be a payment processor themselves. They don't have direct relationships with banks. They might just simply be a referral source. And so they will essentially connect their clients with a processor or an acquirer. They may make some commissions or residual payments off of that relationship, but they don't have a lot of control over the relationship. In fact, there might be some question about if their client wants to change payment providers later, can they do that and cut the referral agent out? Possibly so. This is where sort of contracts come into place. But the portability of a merchant for that referral source, that software company, being able to keep the customer relationship on the payment side is sort of one of their considerations. We do see in some of these other models, and it's on the list here, but there's acronyms at the bottom. We'll just keep it easy and talk about ISOs. That stands for Independent Sales Organization. It's sort of a payments concept, like a merchant services provider, which is the MSPS there. But they are resellers of payment services. They often have a direct relationship with a financial institution that has a direct relationship with the payment networks if it's needed there. They have a little bit more control over the customer relationship. In fact, they do a lot more with the merchants, as we would call them in the space, the industry providers that are providing the services to end user consumers. But they will take on more obligations. They'll have a direct contractual relationship. They'll do more, they'll get more involved in pricing. They'll get more involved in underwriting and risk management and those types of things. In the middle of that, and one thing that we will add next is there's a concept of a payment facilitator. This is where we might see a lot of software companies, in fact, moving to go. So they want to get out of that sort of referral relationship space. They're not ready quite to be an ISO, but they will become a payment facilitator. It's a sort of a recognized concept, at least this under the card brand schemes, where they can actually sign up almost like a super merchant or a master merchant and get the payment processing services, contract it to receive them, and then essentially almost like subcontract them out to a bunch of sub merchants underneath them. And that could be a whole host of medical offices and sort of the area they're serving. So this is a little bit of a hybrid between a step above the referral agent, maybe not quite the ISO, but they get payment facilitators more involved in sort of managing how the funds are flowing. They might, if there is a payment to be made, they might actually take settlement of those funds into their account first before paying out medical offices. They might have an ability to make some more money that way, higher commissions. They'll do more customer service types of functions, and probably get involved, although not always get involved in underwriting and onboarding processes for these the various offices that they might provide these services to. So just a little bit of a sense of the model. We talk about it because these it is very popular in the healthcare space. So this is why we've focused here a little bit. We have talked about some of these concepts already, but agreements again become very important to set up. Payment facilitators are going to have an agreement as sort of that super merchant category that they will have to negotiate. They then will have these sub-merchant agreements with the providers that they're providing the payment services to. And again, there's a lot of considerations there to think about in terms of customer relationships and obligations and responsibilities. One reason why sometimes software companies aren't comfortable moving out of the referral arrangement into this is because there's a little bit more on them in terms of registering themselves with the payment card networks. They take on perhaps some more responsibilities with monitoring transactions. Andrew will talk a bit later about sort of AML, OFAC compliance obligations, but while a lot of that still may stay with sort of up the chain with the banks and who the payment facilitator is contracting with, they do more monitoring and things like that. They will do the underwriting, as I mentioned. They've got more obligations on the PCI compliance side. That's payment, that's short for payment card industry, data security type standards that are relevant to card payments. And they have to have a whole slew of policies and procedures in place to make sure that they're doing everything right. So it's very worthwhile and very lucrative to get to this spot, but there's a lot of work involved, as you can see here.
Yeah, I would just kind of say if you're looking at companies in the payment space and how they're, if they're trying to provide services to medical providers, kind of on the continuum of complexity, the payment facilitator is definitely the more complex model, but it also gives the payments company more control over the kind of the relationship with the medical provider, for example. So if you've got, a software program, but you're, acting more as like a referral agent to another processor to actually process the payments, or to a sponsor bank, you'll probably have less control over your relationship with that medical provider. And you have to rely a lot more on your third party, the sponsor bank or the processor to help. The benefit of the payment facilitator, while, Ellen mentioned there's more compliance obligations, you will have more control over your end customer, and have the ability, if it's set up correctly, to more easily switch to different sponsor banks maybe that support it, or to have multiple sponsor bank relationships that you can leverage, et cetera. So it's not necessarily the easiest model for somebody that's getting started, maybe an initial startup company, but I think we see as companies mature, they kind of move more towards this payment facilitator model, so that they have kind of some of the advantages of it, and they've scaled up enough where they can also, manage the compliance aspects of it too.
And just to wrap up cards for a second, we will see other models, and we're not going to go into them here, but if you are in this space and you're thinking about models, there are other ones. I mean, merchant of record is something that comes up. We see models that actually are often created in name and sort of function that aren't really already fit nicely into a rules-based program. So if you are in the space and doing payments, or what, no matter what side you're on of this, models should really be vetted, because different rules apply. Sometimes they're people take some liberties with certain models that maybe they shouldn't have. So I'm just a word about different payment models on that. Okay.
So we quickly touched on just card processing, but what are the other models? I mean, essentially, Ellen, you were alluding to this, but it would be helpful to, I think, talk about this, because we've got to a point where cash and checks just aren't used anymore, right? But in some cases, you may not have consumers, patients that have cards to use. So I think it'd be interesting to ask, to talk a little bit about the other models.
Yeah. Thanks, Ari. And I'm happy to kind of talk about ACH processing, which is one of the other kind of models that's oftentimes used for making payments. But I do just mindful also, as we noted from the get-go, a lot of we're focusing is on kind of the merchant acceptance side, but on the card side too, it is worth mentioning again that there are models that are developing for card issuance. And so I want to briefly touch on that before we continue into the ACH section. And in these, card issuing programs, you can have a payments company or a fintech that, partners with an issuing card bank to help, set up a program where consumers can pay medical providers, for services that maybe are not covered by insurance, or maybe they have, only partially covered. And so there's, a copay aspect or something like that. And so there, the payments company, rather than kind of helping the merchant receive payment, it's more of like helping the consumer push a payment to the medical provider through, it could be a prepaid card that gets issued. It could be a virtual credit card. And there's a lot of different models that companies kind of explore in this. Some of these models are based on kind of a good funds arrangement where the consumer has to provide funds up front in order to generate the card, and others it could be a credit model. So that's another area where there is certainly a lot of innovation happening. But the other kind of alternative to cards, in large part here in the U.S. and certainly in in healthcare payments is ACH processing, right? Automated clearinghouse payments. And these involve electronic transfers of funds between accounts at banks or credit unions, right? And the kind of the crediting and the debiting of funds in between different accounts. Typically, the bank can issue instructions to debit or credit accounts, based on instructions they get through their customers. But what we see in the payment space a lot, again, is banks will partner and sponsor a third party that is got relationships with end users to facilitate payments. And whereas in the card side, we're talking about payment facilitators as kind of the model. The rough equivalent in the ACH side are called third-party senders. So a bank can sponsor a non-bank partner called a third-party sender that will in turn have relationships with medical providers, for example. And the third-party sender can then send instructions to the bank to debit a patient's account, for example, to make a payment, or to even push a payment on behalf of a patient to a medical provider. And so those are kind of the way ACH works. It's it's just an alternative payment model to cards. ACH has been around for many decades as well, and is a very common model that is used to facilitate payments. Focusing on third-party senders, which is where a lot of the payments companies and fintechs in this space will be. They also have regulatory obligations similar to what you might see from a payment facilitator on the card side. The bank that is sponsoring the third-party sender has to register that third-party sender with NACHA, which is the kind of the nonprofit association that sets rules for ACH. The sponsor bank has to have a specific kind of agreement in place with the third-party sender. The third-party sender has its own kind of obligations when it is submitting payment instructions through the ACH network. Kind of risk, common kind of risk management type issues that need to be followed. A wrinkle that you see with third-party sender models that you don't see on the card side is you can get more of a daisy chain of third-party senders that are kind of linked together, where the bank that is ultimately submitting the payment instructions into the ACH system, there could be two or more kind of third-party senders in between the bank and the person that's kind of originating that payment instructor, and these are called nested third-party senders. And these kind of relationships are permitted. They're not permitted on the card side. In the card side, like a payment facilitator cannot process payments for another payment facilitator, but it is permitted on the ACH side. But it's definitely viewed as higher risk. A number of banks, don't kind of support that model at all. But it is something that is kind of a higher risk model that you might find in third-party sender arrangements. In terms of, I think that's probably kind of a good general overview of ACH. If we want to move into some of the kind of regulatory considerations, we can keep moving through the slides.
Ellen, you got to unmute.
I was on mute. Okay, so we will. There's a lot of regulatory ground to cover. We're going to start here with sort of risk management basics. If you are this is really, think here where the customer is going to be on the payments acceptance side. So a healthcare provider of some kind accepting payments. They're the ones who are taking and needing payment processing type services. So the entity that is providing that service, whether it's an ISO, maybe a payment facilitator, it could be a bank, financial institution directly, they do have various requirements and obligations that are imposed upon them. A lot of these flow through the regulatory requirements of bank regulators. So there are concepts here to sort of do appropriate underwriting and customer due diligence. There's a concept of know your customer in this space, knowing what kind of transactions they're going to be processing, knowing exactly who is operating the business. There's basic sort of checking and due diligence requirements that will be applicable to everybody. In some cases, when the end user I'm sorry, not the end, the customer, the medical provider, the healthcare entity, the merchant, I'll just say, might be operating in a higher risk environment, then there will be some enhanced due diligence requirements. It's hard to think of anything in healthcare that would seem to be high risk. High risk means a lot of things. It could be like a high risk of fraud against patients and consumers in the payments area, or potentially people set up transaction processing accounts for money laundering or other purposes, but this is really what you're checking for. But in this space, payment transactions that are not conducted face-to-face are higher risk. So think about the emergence of telehealth, phone-based transactions, online payments are often higher risk. Certainly recurring payments. If there is any sort of subscription-based payment plan, is a little bit higher risk. So there are some extra sort of due diligence things to think about there. There's Andrew, you might want to take just one quick minute and talk about sort of AML, OFAC responsibilities and obligations.
Yes, absolutely. And I also want to get, we did get an audience question that I want to make sure that we get to. The question has to do with the sub-merchant relationship, when we're talking about a payment facilitator or kind of in the third-party sender model, where you have this service provider kind of in between the bank and the actual healthcare provider. Is that irrelevant if the healthcare provider has its own merchant account? And that's absolutely right. A merchant, whether it's a doctor's office or a hospital system, whatever it may be, they can always have a direct merchant processing agreement with a sponsor bank where they just process all of their own transactions through their own merchant account. And in that model, there's no intermediary. And that's going to be a much more common model for large, well-established, higher volume entities where it just makes sense for them probably to have a more direct relationship with the sponsor bank. And in those cases, it could be that, the sponsor bank isn't just providing their merchant processing, they're also providing their treasury management services, et cetera. But where you really see the payment facilitator and that third-party sender model being very successful is for smaller merchants, right? Individual practices and kind of smaller, entities out there where it's a lot easier for them to kind of sign up to process payments through an intermediary than to go directly to a bank and to execute that way. So yeah, I mean, there's certainly nothing that stops a healthcare entity from having a direct merchant processing account. So moving on then to kind of AML and KYC requirements. Well, if you do have your own direct merchant processing account, like I just mentioned, the bank's going to perform its anti-money laundering and know its customer requirements down onto the healthcare entity, right? So they're going to collect certain information from the merchant that they can verify that they know the identification. They're probably going to need to get ownership information called beneficial ownership of the legal entity, so they know who the true owners of the business are. They'll probably perform some amount of customer due diligence. They're going to want to know your transaction volume, any history of high chargebacks, returns, et cetera. And then they're going to monitor the merchant for suspicious activity. And that could be, high chargeback and return rates. It could be high complaints that are received from customers, whatever it may be. And the bank has that obligation under federal law basically to do that. And they'll do it to their direct merchants. Now, when a bank is working with a intermediary partner, right? So your payment facilitator or your third-party sender, it may be that the bank will kind of push down some of those requirements and have the payment facilitator or the third-party sender help collect customer information and perform due diligence and help monitor for suspicious activity. So if you're a payments company in this space and you're looking to kind of play that intermediary role between the bank and the ultimate merchant, you need to expect the bank to push down these obligations. You're going to have, not just policies and procedures, but most likely software that you can leverage to help do customer identification and beneficial ownership verification, performing customer due diligence and underwriting, and monitoring for suspicious activities, and being able to report that kind of stuff up to your bank partner, so that they're able to manage the risks and take care of their own regulatory obligations. Kind of related to general AML, and this is an important question in particular for intermediaries, is the concept of money transmission. Money transmission is a regulated activity under federal and state law that involves basically the receipt of funds and the transmission of funds, right? And at the federal level, this is where the anti-money laundering aspect comes in. Money transmitters are required to comply with kind of these anti-money laundering program requirements, right? So a money transmitter is a regulated entity that needs to perform AML on its customers and has to get licensed in 49 different jurisdictions across the country. And this is a big issue for these payment intermediaries, because if you are a payment facilitator or if you are a third-party sender, you may find yourself in a position where you're helping move money on behalf of your end customers, right? You're helping facilitate the receipt of payments, et cetera. But if you receive those funds into your own bank accounts and then transmit them out to your customers, right? So if you're a payment facilitator, for example, and you're processing card transactions, if the bank is settling those card funds to the payment facilitator and the payment facilitator is then turning around and paying it out to their customers, that's probably going to trigger the definition of money transmission at the federal and state levels, because that payment facilitator will have received those card settlement proceeds and transmitted them, right? Same on the third-party sender side. If the third-party sender is receiving ACH payments through its bank and then paying those out to medical providers, that third-party sender has engaged in money transmission. Now, there's nothing wrong with engaging in money transmission. It's just that you have to get licensed in 49 states to do that. And then under federal law, you have various AML obligations. And getting licensed on a nationwide basis is a relatively comprehensive and robust process. You typically hear kind of the common phrase is it takes 12 to 18 months to get licensed, right? And it's a pretty, comprehensive process of having to submit a lot of information on the company, its owners, its business model, its finances, right? And the reason is that the states, they want to make sure that these intermediaries, if they are receiving money that's owed to a third party, that they are responsible. I mean, it's akin to a banking activity, and so they want it to be regulated. And what you do see oftentimes is a lot of the well-established, larger payment facilitators and third-party senders, they've gotten money transmission licenses because it actually can become a competitive benefit. It gives you a lot of flexibility to be able to move funds and to take control of that and not have to rely as much on your bank partners. And so it can be very beneficial, but it's certainly a heavy lift for a company that is just starting up or hasn't really scaled up to a point where it makes sense. And so as a result of that, there's a lot of models that have been developed to help these intermediary payments companies not trigger money transmission. And the gist of it is finding ways to take this intermediary, the payment facilitator, the third-party sender, for example, how do we take them out of the payment funds flow? And the model that has been developed, and it's not just a model in payment processing, it's used in kind of the card issuing space and various other fintech, verticals that involve, the movement of money. But essentially, the bank partner will set up a custodial account, often called a for the benefit or an FBO account, where the non-bank payments company will provide instructions to the bank on kind of moving funds into this custodial account, but the custodial account is owned and controlled by the bank ultimately. And the payments company's role is just limited to issuing instructions, right? So they'll provide instructions to process this particular payment, and then this payment, instructions on where to send it to pay out. And the goal of this model is that the payments company has a reasonable argument that it's not in the flow of funds. And going back to the definition of money transmission, it is the receipt and the transmission of funds. And if you're not ever actually receiving those funds because they're going into a bank-owned account, then that payments company has a reasonable argument that it did not engage in money transmission. And so this has become a very common model that is used, as I said, not just in the payment space, but kind of across various different types of fintech industries. The challenge with these FBO accounts, and there historically has been very little guidance from a regulatory perspective on how to use these accounts and how to set them up. At the federal level, the federal banking regulators are starting to take a closer look at these to understand kind of what are some of the risks, what kind of controls need to be in place. There is a pending FDIC rulemaking that would establish better record-keeping requirements for these FBO accounts, so that in the event the non-bank or the bank goes belly up and insolvent, that the federal regulators are able to do deposit insurance, right, and know exactly whose funds do these all belong to, et cetera. So this is a model that is very common and is continues to be used very frequently, but it is starting to get more scrutiny at the federal level.
Okay. All right. So I think we were just gonna next just do sort of a round robin of sort of various recent developments that may impact what we're talking about and those types of things. And just another word too. There are other things that will be involved in sort of healthcare payments that should be discussed in its own forum at some point. But we've talked about privacy considerations. Data privacy is a big thing. As I mentioned, the payment cards have a payment card industry data security standard that is constantly evolving and being updated, and that very much comes into play here. There are, of course, all of your own privacy considerations in the healthcare space that need to be addressed in this as well. And sort of this is where you have to make sure you have covered this issue from lots of grounds, because and this is something that new players in the space who are getting involved in providing payments functions to this industry really do need to understand that from qualified people who understand some of these privacy and other regulations. So it's this in itself was a multi-layered industry, and so I just wanted to address that because we had some questions about that. So on recent developments, Andrew, do you want to maybe start with 1033 rulemakings? And
sure. Well, I mean, we're kind of at an interesting point in the talking about recent regulatory developments at the federal level, because there's been obviously a new presidential administration is in place as of the last 2 days, and the Trump administration will be taking a very close look at a lot of the regulatory issues that are currently on deck and remain kind of open. And over the last few years, the federal banking and consumer protection regulators have been taking a much closer look at payments, and especially payments that kind of intersect with financial privacy rights and kind of big tech companies and the like. And the CFPB, the Consumer Financial Protection Bureau, for example, has had a number of different rulemakings that touch on things like digital wallets and supervising them and the rules that regulate them. And so it'll be interesting to see how these CFPB priorities, which have been developing under the prior Biden administration. Whether or not the new Trump administration will continue some of these or reverse some of these. I'd mentioned the FDIC rule on FBO accounts, the proposed rule, right? These all are going to get a look from the new administration. We'll have to monitor these things very carefully to kind of know where things will be headed for the next 4 years. But one recent development that actually has become a finalized rule is the CFPB's what is called the 1033 rulemaking, which is its personal financial data rights rule. And this is a rule that came into place. It's been many years in development, but finally came into place kind of last year, which requires banks to make information that they have about their consumer customers available to third parties, right? So if you're a payments company or a fintech and you're looking to help consumers with various types of payments or other financial transactions, having access to their bank account and kind of the records and information of transactions is really valuable, right? And in a lot of cases, consumers, want, if they're signing up for some kind of a fintech service, they want that partner to be able to access their bank records so that they can, facilitate those services. In the past, that was not necessarily easily done. Some banks would execute agreements with different fintechs that would allow them to get access to that information. Some fintechs would take the consumer's login credentials and just kind of log in themselves to kind of get information. But this CFPB rule came out and it actually establishes a requirement that banks make this information available to authorized third parties when directed by a consumer, and kind of establish some of the data security and kind of some of the consumer protection aspects that go around it. This concept of access and control over an individual's financial information is pretty well established in Europe. The US has been a little bit slower in adopting it. But I think with this new rulemaking, you're going to see a lot of payments companies and others that will be able to leverage, the availability of this data to provide, different and better services to consumers, especially like on the bill payment side, right? Being able to verify like how many funds do you have available in your account? Can you make this transaction? Things like that. So that is one, CFPB development that is certainly going to be moving forward. And, when it comes to some of the other federal developments, like the FBO, FDIC's FBO rule, we're just gonna have to monitor and see how the current administration handles those.
So I might switch gears for a little bit and talk about some of the consumer protection related things that have been started over the last couple of years, and we'll have to see how they flow into new administrative policies. But one of the issues would relate to the costs of processing payments, the cost of processing electronic payments. I mean, certainly there is a cost to mail paper statements and receive checks and do everything to mail, wait for payment, collect late fees, whatever. But and that's the whole reason why electronic payments and faster payments is of such great interest. But there is a cost. It costs. The payment networks have their fees. The banks have work to do to put into this to move the money. The intermediaries have costs that they need to have covered and sort of onboarding and monitoring transactions. So when you have a payment processing account, if you're a healthcare provider and you want to take electronic payments, you're paying. So every $100 transaction, you might only get $97 back for it. So the rest of it is split out in fees. So this gets into a concept of charging the end user, the patient, a fee to actually make the payment. And many of you have seen this in a lot of different concepts. When you've gone to pay a bill online, it may be that if you're going to pay with a credit card, they're going to add on a 3 or 4%. They might call it a credit card processing fee or a payment convenience fee or something. It's a surcharge really for the use of that card. they may not charge it if you select to pay maybe with the ACH method and have the money come straight out of your account, or maybe they do charge a fee there too. There's all sorts of constructs for these fees, but it is maybe a fee that the patient wasn't expecting to pay. They just want to pay their bill. They don't want to write a check, but they also don't want to add an extra 4% off of their payment. So this gets into concepts that have been highly talked about sort of in the consumer protection world of add-on fees, surprise fees, undisclosed costs of doing things. There are rules around this. The payment networks have rules around this on the card side for surcharging, credit card payments that need to be followed. The federal law, interestingly, does not actually prohibit surcharging like this, but there are some state requirements and restrictions to be mindful of if you are looking to add on that fee to a payment. And again, it's there often to recoup your own costs of processing payments if you're the provider in the space. But you have to be mindful of the various different laws. And this comes down to a consumer protection issue in the sense of making sure it is disclosed. There's now, for example, emerging state laws that are more directly targeting undisclosed fees. California, for example, for the last 6 months or so has had a pricing law in place saying that whatever price you tell the consumer, that's the price that they expect to pay, and that's the price that they are that they will pay essentially. And if you were going to add something into that, like a payment processing fee, you needed to have told them that up front. And so that's an area where it's potentially ripe for class action lawsuits, and we're seeing those filed under this California law in a lot of different industries. So something there that, we would certainly, pay attention to and check that out. Other things going on in the consumer protection space, there could be potentially recurring payments. That's also highly regulated now. If think about even alternative health payment services, you may sign up for monthly access to services. There's all sorts of rules and regulations and law enforcement now around subscription-based billing. So that's something that we could see coming into play here. There are also those same subscription rules. Actually, the Federal Trade Commission has a new rule out that governs subscription-based payments or anything that has an automatic renewal provision to it. So if you say like, look, I'm going to agree that I'm going to continue to pay every month or every year for a health and wellness type feature or whatever else, it's now subject to, or will be when effective in May, unless something changes, but subject to very specific disclosure and consent and cancellation requirements put out by the FTC. But those same requirements will also apply to business transactions. So we think about this for some of our smaller sort of payment intermediaries, let's say a payment facilitator that wants to contract with medical offices to provide payment services and have that contract renew on an automatic renewal basis. That automatic renewal portion of it is potentially subject to this consumer protection law, because that would be particularly true if the medical provider is a smaller office or a small group of offices. Our regulators treat small businesses and like consumers. So these are some of the things we look out for in the payment space. Even they're not often thought of whenever we're thinking about all these fintech things and money movement, but sort of that end user customer experience is also something that we very much are paying attention to. And then we watch developments here in concepts like open banking. Open banking is, where, you can, you have a fintech in place who can actually more directly help move money between banks or get access directly into bank account information to facilitate, the movement of funds. Faster payments comes into this. There's a lot of looking at how how bills can be paid more quickly, how funds could be settled more quickly. This is, again, very desirable because we're not waiting so long to get our payments in. But there are regulations that will apply to faster payments too. So even our existing sort of electronic fund transfer laws that are in place, we have to see how those play into faster payments. You have to, again, think about the consumer rights that are here, recourse if they feel like a payment might have been fraudulently made or taken from their account, or if they disagreed with the service and want to get their money back, all sorts of things. So there's quite a bit going on here.
Yeah. And it's another question that we got that I think is worth keeping in mind is, what specifically might a payment facilitator or another payment company in the healthcare industry need to know about it, aside of some of the kind of the general concepts that we've been talking about. I mean, obviously, kind of some of the data privacy and HIPAA aspects of it will be particularly important for a company that's providing services in the healthcare space. And then I think a lot of it will also depend on a lot of these payments companies. They really try to provide additional value by having other software services that they provide. And sometimes it's actually the reverse, right? It's an accounting software company or some kind of an invoice management company or whatever it may be that then adds a payments component because they see the payments as the value add to their existing core services. So in the healthcare space in particular, I think a lot of the additional issues that can come into play will be based on, what additional services or activities is this, payments company engaging in, right? And obviously there's, large regulatory frameworks on, Medicare and Medicaid and kind of the CMS rules, or maybe, insurance requirements and the like. But it can even include something like if you're a company that's helping process payments and helping your healthcare providers then collect on outstanding AR that might be owed and engaging in kind of collection activities. Well, that raises, consumer protection and potentially state licensing issues for engaging in that kind of collection activity. So I think for, payments companies in the healthcare space, it's not just knowing, what are some of the payments issues that we've talked about, but it's understanding what other services are we providing, and do those also raise additional regulatory consideration. Ellen, should we end? And Ari, definitely, welcome your insight as well. Kind of any final thoughts on, if you're looking to invest in a healthcare payments company, like what are just some general things to keep in mind as somebody that's maybe performing due diligence or looking into a company?
Well, Andrew, it's interesting. I mean, thank you. Just to add on to what you just said, is that on the health regulatory side, when you're thinking about payment issues and taking payments early, for example, before you've rendered a service, or taking payments in advance of billing the insurance, that essentially saying, hey, look, pay full freight for your service, and then if insurance pays us, we'll refund the difference to you, kind of thing. There may very well be banking financial rules around that, but there's also contractual rules with healthcare payers that come into play there. There's rules with Medicare and Medicaid that come into play there, in terms of that you have to be careful. You in certain cases, if you've got, depending on the structure of your contracts with a health insurer, the commercial health insurer, you may be prohibited from billing them for the service until you've actually billed the insurer first, right? And so taking the patient's credit card and charging it, right, before you've actually billed the insurer, you may be contractually prohibited from. And you just have to obviously be aware of those rules. And as a payment processor, you're not going to be aware of every client's contracts with their commercial payers, but you at least need to be aware of the issues so that you're making sure that they're not running afoul of it as well, and you're in the middle of them running afoul of it.
Mm-hmm.
Exactly. I mean, that's exactly right. And I think, if we're talking about, diligence, there's obviously a lot of different things that you can look at. One of the areas that I think is pretty important if you're looking to invest on the payment side is, where is the target company on that continuum of, growth and sophistication? Because, if you're an ISO or referral agent, their contractual relationship with their bank partner may inhibit or lessen their ability to control their customer relationship in a certain way. Because at the end of the day, if you're just a referral agent or an ISO, it's your bank partner that has that direct agreement with the merchant. And so, if you come in and you invest in a healthcare company and you've got strategic goals for it and you want to switch to a different payment processor, well, you better look at diligence to see, like, do they have an exclusive relationship with their sponsor bank? And is it for the next 5 years? And what happens when they want to switch over? Do they actually get cooperation from the bank? Do they have the ability to control where the merchant accounts go? Or would they have to kind of start all over when that relationship ends, right? And those are the types of issues that oftentimes don't get looked at early on in a relationship, but then on the back end, as you start to scale up and get interest from potential investors, can become a pretty big deal.
Yeah, and interestingly, in diligence as well as just in your business, this is a more practical thing that, so many providers have commercial banking relationships, right? Just for their everyday banking. And many of those relationships basically say, use our processing services, right? They're somehow baked into the relationship. And if you've then gone to one of the large electronic health record vendors or one of the large revenue cycle management vendors or something else in the contract with those vendors, right? Or accounting services software vendors, right? Also has a payment processing thing to it and a requirement in some way to use that. You've got to be smart about, well, wait a minute, I can't obligate myself to use two different payment processors for the same purpose, right? I've got to be careful. I mean, we've seen that once in a blue moon where somebody essentially is technically in breach of an agreement because they're not using the payment processor that some other business relationship they have is technically requires them to, because they've always been using their commercial bank's payment processor, whatever that might be, and they're not using the one that some other vendor is supposedly requiring them by contract to use. So that's more of a practical thing to be sure that you know what you've agreed to or what you're about to agree to. And then in diligence, it's certainly something to look at to make sure that there's no sort of technical foot faults of you seem to have agreed to be using 5 different processors, right?
Yeah. I think another area that is really important on the diligence side, on the in the payment space, is to go to that issue of money transmission that we talked about, because if you're investing or buying a company. And it turns out that they're set up so that they're engaged in unlicensed money transmission. That can result in state investigations and enforcement actions, which result in penalties that have to get paid, and maybe reputational harm, and an impact to the ability to be able to provide the service in a particular state, for example, until you get that license. But what can be even equally as concerning as maybe the penalties is that a lot of these businesses, they build up their model based on a certain structure. And it turns out if that involves unlicensed money transmission, it's really hard to reverse course and to change your underlying structure and business model on a dime, right? It's just not something that you can necessarily easily do. It could impact the economics of your business, all of your different contracts, the compliance that goes along with it. So making sure that if you're looking at a company, do they present risk of money transmission? Yes or no? If they do present a risk, like how easy would it be to, mitigate or resolve that risk? Whether it's, finding a way to structure it so you don't, engage in money transmission, but, you can't count on, gee, let's go out and get these licenses because it's going to take months to do that. And it's a pretty expensive proposition. So that's definitely a big aspect of diligence considerations in this space.
Well, great. Alan, Andrew, anything else for the good of the order? I thought this was really, really informative and wonderful and great discussion with both of you.
Well, thanks for having us. We there might have been a couple questions that came through we didn't get to. We're happy to follow up with anybody individually. There's a lot of interesting nuances to this and some state things going on. So thank you all for tuning in and thanks for having us.
Yeah, thank you, everybody. Thanks for joining us. Have a good day.